Hello everyone, it's Daniel Martin. Now let's go into more details. So I'm going to explain a bit more how I handle it. So for that, I'm going to use the help of Maria and Peter to discuss this topic and for you to think more about in details. I'm welcome to verify all the information that I'm going to share with all of you. Remember, this is my own experience, my own way of trading, my own way of doing investments, is my own personal way of handle it. So it's not a recommendation and nothing else whatsoever, but I want you to think, and this is the way we're gonna working out. This is an audio and you can actually see me there. If I have to add something on top of the article or the discussion, I will add it. If not, you will see me just listen to you guys and listen to Peter and Maria at the same time to all of you. So let's play that now. Let's see what happens.
If you're tracking the economy at all right now,
Yeah.
the biggest conversation, the only conversation really, is what the central bank is going to do next.
Right. Are they going to hold or are they going to cut?
Exactly. And, common sense tells us that rate cuts, well, they're good news, right? They're supposed to ease pressure, stimulate growth.
Yeah.
They sound like the rescue boat coming to shore.
And that's the paradox.
Yeah.
That's exactly the paradox we're digging into today, because our sources show, they show one of the most counterintuitive things in finance. The moment that rescue boat, the REIT, shows up on the horizon. History says that's precisely when the stock market is setting itself up for the worst of the damage. It's a confirmed signal of increasing risk, not relief.
Exactly. And we're not doing market timing here. That's a zero-sum game. This whole deep dive is about taking over a century of data to build a purely probability-based risk framework.
Yes.
We want to get away from emotion, get toward the evidence, and just ask.
Exactly. I want you guys to understand this very clear. This is just a pure data to avoid for you to think about by emotions what to do in the case of crisis. It's just exactly to follow those mathematical calculations and follow those probabilities. That's it. Because in a crisis, everyone panic. Yeah, so be aware of that. But if you follow that rules, even in the worst case scenarios, is when the professionals shine and survive the big crashes. So let's go for it.
What is the base probability of a major downturn after a policy shift has already happened?
And our mission today is to turn that historical pattern into something practical, something that gives you a tool for capital preservation. We'll unpack the data, we'll get into the confirmation of deterioration theory, the why behind this whole thing, and then translate it all into a structured, evidence-based cash allocation strategy.
Okay, so let's unpack this with some structure. To really use this historical data, we first have to agree on what a big crash even means.
A clear definition is key.
Right, and in the source material, the analysis uses a very clear hard and fast rule. A peak-to-trough drawdown of minus 20% or more. For the early data, they use the Dow, and then after 1957, they switch over to the S&P 500.
And when
Yes.
you map that definition against U.S. history, say going back to about 1917, you find something like 17 of these big events.
17. So on average, that sounds like a major crash happens,
Yeah.
but roughly once every 6 years.
Roughly, yeah. But that averages. It's incredibly misleading.
Oh, absolutely. This is where the nuance is, and honestly, the danger.
Yeah.
Because if you look at the gaps between them, calendar timing it falls apart. It's useless.
Totally useless. You see them back to back, like in 1980 and then 81, 82.
And I have seen this, so guys, this is I see often that people talking in internet about these probabilities of 6 years, 2 years, 1 year, whatever. There will be so many crashes somewhere. This is nonsense. It's not relevant. It's not enough evidence to use it. It's not. So, and this is, you can prove it with the data analysis. It doesn't make sense. In some cases, if you see my other video, some cases it's 2 years, sometimes 6 years, sometimes 13 years. So it's 9 years. There is no pattern of 666 or whatever. So you don't know when it's going to happen. High probability after 6 years is not neither. I tried to figure out all the probabilities and patterns on that assumption of every 6 years, and it's not working. So that is what I have now with the interest rate cut, is where it really works.
A couple years apart. And then you get these huge long stretches. What was it, 13 years between 87 and the dot-com bust in 2000?
13 years. It's easy to get complacent after a run like that, isn't it?
Oh, completely. The market lulls you into thinking the rules have changed, but they haven't.
Which brings us to the core finding. The idea that conditions, specifically monetary conditions, matter so much more than just time passing. And this is where it gets...
Well, it's really compelling. The combined data shows that somewhere around 81 to 83%.
An overwhelming majority.
An overwhelming majority of all major market crashes happened during or after monetary easing had already started. That's the probability. That's the number you really have to internalize. It sets the baseline risk for everything else we're going to talk about.
Just to simplify that, is like when you see, if you go to the interest rates and you see the interest is going up, that's a good news. The economy is doing well. Yeah, something happens that trigger to doing well and that more. Why? Because they want, probably because they want to take money from you. You're doing well to take money from you. So they're pushing up the economy. But if it's flat, it's as well good news. If it's actually start to go down, high probability, as I said in the discussion, 82% probability to crash. Big one.
Now, the sources do break this down into two different policy regimes, but the pattern is basically the same.
So why does that matter, the pre-1950 versus post-1950 distinction?
It matters because the tools the Fed used were different, but the intent was the same. You know, before 1950, they focused on the discount rate, direct bank lending, liquidity.
Okay.
After 1950, it all shifted to the Fed funds rate managing the cost of money.
And the psychology from 1970s to now is never changed. So micropsychology is still working out as well. Be aware of that.
But in the early days, 4 out of 5 big crashes followed easing. And in the modern era, 10 out of 12.
10 out of 12. That's incredible. The only modern exceptions since 1950 were, what, the flash crash in 87 and then 2022, which was a hiking cycle, a totally different animal.
Right. So the message is just, it's crystal clear. When the central bank starts easing, your antenna should go way up.
Which moves us straight into the why, the confirmation of deterioration theory.
Exactly. The central bank does not cut rates because the economy is booming. It's just that simple. Rate cuts don't cause the crash. They're confirming that deep problems are already there.
But hold on, if the market is supposed to be this great forward-looking machine, why does it need the Fed to stamp its approval on the bad news? Why isn't this priced in before the first cut?
Because markets, especially after a long bull run, are. They're prone to inertia, to optimism. Yeah. They operate under this sort of baked-in belief that the Fed has a magic bullet. So when the Fed finally does cut, it's an official institutional confirmation that the problems the market was hoping would just go away. Well, they're now critical. The central bank is showing its hand. They're admitting the system is stressed.
So what are the specific symptoms that these rate cuts are confirming? What are they seeing?
They're seeing the hard data. They see clear evidence that growth is slowing down fast. They see credit stress. You know, in corporate debt, commercial real estate, it's rising. Corporate earnings aren't just slowing, they're actively getting weaker.
And the really scary one?
The really scary one is they're reacting to signs that something systemic might be breaking under the surface. Money markets freezing up, that kind of thing.
So the whole narrative is flipped. The first cut isn't the cavalry arriving. It's the Fed saying, okay, we've waited as long as we could. The problems are now big enough that we have to act.
Precisely. And because the problems haven't been solved, only acknowledged, markets often keep falling and falling hard after the cuts begin. The worst damage historically happens mid-cycle. Long after that first cut gave everyone that false sense of hope.
So if we accept that risk is rising during easing, the game changes. It's not about prediction anymore. It's not when will it crash, but how much risk should I be carrying right now?
Yes.
And this brings us to the scaling factor, the number of cumulative cuts. Risk doesn't just jump from 0 to 100, it ramps up.
It does. And when you condition the historical data on the number of cuts, you get this beautiful, clear risk gradient. It's the difference between a little turbulence and a systemic crisis.
Okay, walk us through those phases. How does the risk scale up?
So, historically, 1 or 2 cuts. That's generally seen as low risk. Maybe it's just preventive. The Fed is just testing the waters.
Right.
But once you hit 3 to 4 cuts,
1 or 2 cuts, I just ignore it completely and not even bother to make any changes. When they go to 3 and 4, the warnings start to come up. And really, now we are on 6. Be aware of that.
You cross a major threshold. The risk moves into the warning category. This is the point where you really should be adjusting your posture.
And what happens when they get even more aggressive?
5 to 6 cuts. Now you're in high-risk territory. The problems are clearly not going away. Then you get to 7 to 9 cuts. That's Very high risk. This tells you the central bank is genuinely worried and is using some serious firepower.
And the absolute worst case scenario, when the Fed is just throwing everything it has at the problem.
That's 10 or more cuts.
When it's 10 more cut, it's just 90 for me. I keep 90% of my capital in safety. Yeah, I learned that on the hard way in 2008. And then from there, I found a way to fix it, to be able to be safe. And I was working in COVID-19. Anyway, let's keep going.
That's the critical or systemic risk phase.
Yeah.
Historically, when an easing cycle gets that deep, the probability of a major crisis, we're talking much bigger than 20%, approaches 80 to 90%.
So the real takeaway is that the big devastating crashes 2008, the dot-com bust, they didn't happen after just one or two cuts. They clustered after the Fed had made many, many moves, confirming how bad things really were.
Absolutely. The data tells you a low number of cuts, you're likely looking at a manageable correction. A high number of cuts, you're likely looking at a systemic crisis.
Which brings us from the theory to the practical tool, the cash allocation framework. If we know the probability of a catastrophic loss goes up with each cut, then the rule has to be, when probability dominates, capital preservation has to dominate.
You connect that rising probability directly to your strategy. So in the expansion phase, 0 cuts,
So this is now an estimation. I have my specific ones. And remember, this is not a recommendation. This is my own calculations. And even that is not exactly the right percentage. It depends if your portfolio distribution is much longer to explain. But it is an example to you to be aware of and thinking about what to do in those cases.
low cash allocation is fine. 10, 20% maybe.
And then you ratchet it up from there.
You ratchet it up. The Fed makes its first 1 or 2 cuts. That's your low risk phase. You scale cash up to, say, 20 to 30%. Then you hit the warning phase, 3 to 4 cuts. Now you're at 40 to 50% cash.
And once you're in the real danger zone, high risk and beyond.
At 5 to 6 cuts, high risk, you should be looking at 60 to 70% cash based on this framework. Very high, 7 to 9 cuts, you're at 80 to 90%. And at that critical level, 10 plus cuts, you're staying near 90% cash.
It's just a direct mirror of the rising risk.
It mirrors the rising probability, the rising uncertainty, and this is critical, the rising downside asymmetry. The problem is getting worse and you need maximum protection.
Let's really hammer home what.
Now, before we go into more details, I do not treat this is USA, which is not everything. I got my portfolio on 45%. Is not obviously the rest of the crypto 9%, and the rest non-USA, so means Euro and other countries that take it into account. Those percentages allocated in there is that's when the economy is being affected, or let's say that cut are going into cash into 30%. I will do 50% less into the non-Euro, so it means I will go down 15. So there's 30%. I will go 15% on the non-USA market. This is based as well in probabilities. This is my own personal as well data. Some traders that I know, they go in full cash or they move into bonds, independent of the USA or not, because they believe everything is connected. I do believe it's not. So I use that approach.
Why cash is the tool here. It's not an emotional bet. It's about optionality. But why cash? Why not something like long-term government bonds, which people think of as safe? Can you just quickly touch on duration and correlation risk here?
That's a vital point, because in these systemic crises, safe assets can fail you. Duration risk means that even as the Fed is cutting, bond prices can get really volatile. They aren't a guaranteed safe harbor. But more importantly, there's correlation risk.
And this is based as well on the 100 years of data. So bonds first, they don't produce much percentage to benefit your crash. The crashes don't last more than 2 years. And what's the point to actually to wasting you take the risk of these bonds that potentially can make you damage more than anything else? So maybe it's time to have a break and just wait for the right reasoning to go in again. And that is what I do.
Meaning everything goes down at once.
Exactly. In a true panic, correlations go to 1, stocks, bonds, commodities, everything can fall together.
So cash is the only thing that holds its nominal value and preserves your freedom to act later.
Precisely.
Yeah.
It has no duration risk and no correlation risk. It's pure liquidity. It gives you flexibility. It's why you see disciplined investors like Warren Buffett let their cash pile grow during unstable times. They're not forcing capital into assets that might also be vulnerable.
Okay, now for the Curical reentry insight. If the cut is the danger signal, when does the signal finally turn to safety?
This is probably the most important historical insight of the whole deep dive. Markets do not bottom when rate cuts start.
Okay.
They bottom when rate cuts stop.
When they stop. That makes perfect sense. The cuts begin, that confirms the problem, the market falls. Panic happens mid-cycle after many cuts. And only once the cuts pause does the flow of negative, fear-inducing news from the central bank finally stop.
Yes.
Mostly. No, it's not a guarantee neither. I saw that after that it continued down, and many companies too. So, but it's pretty much you are at the bottom of the structure, and that way is an opportunity with the patience, with a good discipline and a good portfolio distribution. That's the right time to start to allocate it again, and to take your portfolio to a massive growth, because they are in a very low.
Uncertainty stops increasing, and that's when a durable recovery can actually begin. Buying just because the market is down 30% while the Fed is still actively cutting is historically a very dangerous game.
We saw that in 2001, we saw it in 2008.
People got burned. A lot of 30% declines became 50% declines, or worse, because the underlying problem the Fed was fighting hadn't been solved yet.
So the strategy isn't about perfectly timing the last cut, which is impossible.
Yeah.
It's about managing that shift from chaos back to stability. How does the phased reentry work?
Since you can never know the last cut in real time, you have to phase in based on signals of stability. So as long as cuts are ongoing, you stay defensive. You keep that high cash allocation.
Okay.
The first clear pause in the cutting cycle, when the Fed signals they're done for now, that's your first signal to buy. You can cautiously add maybe 10 or 20% back into the market.
Exactly.
And if that pause holds, if it looks like the system is stabilizing.
If stability holds and the pause continues, you can confidently build your allocation back up, maybe 40. To 40 or 50% risk. Yes. The full, all-clear signal historically only comes when the central bank feels confident enough to signal a future hike.
A hike signal. That confirms the crisis is truly over and a new expansion is beginning.
And
that's the real sign. You don't need to catch the exact bottom. You just need to catch that phase change from confirmed chaos to confirmed stability.
That is the critical piece of knowledge here. It's evidence-based risk management.
It is.
This has been...
All right, so guys, I hope you enjoyed this. Welcome to ask me any question. Remember, this is my own personal way of investment. I have done for 25 years, and I believe now we are in critical situations. I will not even bother to make this video if I don't believe is a problem now in the market. I think the main problem I can see right now is that it's unsustainable, the situation globally, about how people live now. They are not able to renting, to pay bills, to have a house, just to live, just to pay for normal. People cutting holidays because they can afford us before. It's just everything it seems to be that it's going down a lot, and make it difficult for the ground, for the people just everyone lives from every country I know. So this is a real problem, and when that happens, remind me 2008. It was the prices of the houses going up and up and up and up, and one day, poof, everything was corrected. So it was unsustainable. People was not able to afford this 100%. Properties go up 100%, 50%, 20% per week. It's impossible. So this is actually something happens on that year, and I believe it's happening now that prices is going up and up more and more. We have less and less in all the countries that I know, and this is unsustainable. So something will happen, something will correct the economy. Don't know what, I don't know how, but I know that's is coming to the beginnings of these situations. It may happen in one cut, 2 more cuts, 3 cuts, I don't know, but I will be actually going into safety, as I've been doing always before, and it's better to be safe than sorry. Alright guys, I hope you liked this video, and I will make more of this content. So if you have any question, feel free, and you can find me on Discord on City Trades Imperium. So guys, bye bye.